When people hear that large corporations pay little or no tax, the immediate reaction is usually outrage. It feels fundamentally unfair. It feels like something has gone wrong, like the system has been corrupted or broken. Individuals work every day, earn income, and see taxes deducted automatically from their paychecks before they even receive the money. Meanwhile, billion-dollar companies report massive revenues and enormous profits, yet somehow manage to contribute surprisingly little in taxes, sometimes nothing at all. The assumption, the natural human reaction, is often that these companies are cheating, that they're hiding money in secret accounts, that they're breaking the law and getting away with it because they're too big or too powerful to face consequences. But in most cases, in the vast majority of situations that generate headlines and public anger, they're not doing anything illegal at all. What's actually happening is more subtle, more structured, and far more revealing about how modern economies are designed, how power operates, and whose interests the system serves. Large companies don't avoid taxes by accident. They don't stumble into favorable outcomes through luck or clever accounting tricks. They do it by operating exactly as the tax system allows, and often, exactly as the tax system actively encourages. Once you understand how corporate taxation really works, once you see the actual mechanisms and incentives built into the structure, the question shifts fundamentally. It stops being, why don't they pay taxes? And becomes, why is the system built this way in the first place? The first thing to understand, the foundational insight that explains everything else, is that corporations are taxed very differently from individuals. The rules are not the same. The logic is not the same. The outcomes are not comparable. Individuals are taxed primarily on income. Money comes in, taxes are calculated, taxes are deducted. It's relatively straightforward. Your salary, your wages, your earnings are taxed at progressive rates depending on how much you make. Corporations are taxed on profits, not revenue, not sales, not the total amount of money flowing through the business. Profit, that difference sounds small. It sounds like a technical detail, an accounting distinction, but it changes everything about how taxation actually works. Profit is not a simple number. It's not something you can just read off a bank statement. It's what remains after costs, expenses, deductions, depreciation, amortization, credits, and losses are subtracted from revenue. And companies have enormous flexibility, enormous legal room to maneuver in how those numbers are structured, timed, categorized, and reported across different jurisdictions and time periods. This means that two companies can generate exactly the same amount of revenue, sell the same products, serve the same markets, and still owe vastly different amounts of tax. The difference isn't fraud, it's structure. One of the most powerful tools companies use, one of the fundamental mechanisms that creates the tax gap, is expense classification. Many costs that individuals would never be able to deduct, expenses that come out of after-tax income for regular people, are considered legitimate, fully deductible business expenses for corporations. Marketing campaigns, legal services, consulting fees, research and development, software licenses, travel expenses, office equipment, technology infrastructure, professional services, even certain types of meals and entertainment can be deducted as business expenses. The more expenses a company can legitimately allocate to operations, document properly, and justify as necessary for business, the lower its taxable profit becomes. And for large, complex organizations with thousands of employees and operations spanning multiple countries, the opportunities to classify expenses are nearly endless. This isn't cheating. It's how corporate taxation is designed to work. Depreciation takes this principle even further and makes it more powerful. When a company buys a large asset, something like machinery, vehicles, buildings, technology infrastructure, or manufacturing equipment, it usually doesn't deduct the full cost immediately in the year of purchase. Instead, the asset is depreciated over time. The cost is spread across multiple years, reflecting the idea that the asset will be used and will generate value for the company over its useful life. But tax laws in many countries allow accelerated depreciation. This means companies can deduct a disproportionately large portion of the asset's cost early in its life cycle, even though the asset continues to generate full value, full productive capacity, for years or decades afterward. On paper, for tax purposes, profits shrink dramatically in the early years. In reality, operationally, cash flow remains strong. The business is functioning profitably. But the tax calculation shows a very different picture. This creates a situation where companies can appear unprofitable for tax purposes while being highly functional, highly valuable, and cash positive in practice. The disconnect between economic reality and tax reporting is built into the system deliberately. Another major factor, another structural advantage, is how companies are allowed to handle losses across time. In many countries, tax systems allow companies to carry losses forward or backward across different years. If a company loses money during an expansion phase, during a period of heavy investment, during market downturns, or during the early stages of building a new business line, it can often use those losses to offset profits later. That means taxes owed in future profitable years can be dramatically reduced or even eliminated entirely by applying losses from previous years. This isn't a loophole that companies discovered by accident. It's an explicit feature deliberately designed into tax codes to encourage long-term investment, risk-taking, and business development. The logic is that companies shouldn't be penalized for taking risks that don't immediately pay off. That innovation and growth require patience. That losses in bad years should balance against profits in good years. But the practical effect is that large companies with long time horizons and complex operations can smooth their tax obligations across decades, minimizing total taxes paid even while generating substantial profits over time. Then there's debt, which plays a surprisingly central role in corporate tax strategy. Interest payments on corporate debt are usually tax deductible. When a company borrows money and pays interest to lenders, that interest counts as a business expense, reducing taxable profit. This creates a powerful, structural incentive for companies to finance operations through borrowing rather than through equity, rather than through retained earnings or shareholder capital. The more debt a company carries, the more interest it pays, and the lower its taxable profit becomes. Debt reduces taxes, even while simultaneously increasing financial risk and leverage. This is one major reason why large corporations are often highly leveraged, carrying substantial debt loads even when they're profitable and could theoretically finance operations differently. Debt isn't just a financing tool, it's a tax optimization tool. At the international level, corporate taxation becomes even more complex, more flexible, and more advantageous for large multinational companies. Many large companies operate across dozens or even hundreds of countries. Each jurisdiction has its own tax rules, its own rates, its own incentives, its own enforcement mechanisms, and its own political priorities. Companies structure their operations strategically to take advantage of these differences. Profits are shifted, costs are allocated, and intellectual property is placed in locations where tax treatment is most favorable. Intellectual property is especially important in this system. Trademarks, patents, algorithms, software code, brand value, proprietary technology, these intangible assets can be owned by subsidiaries in low-tax jurisdictions, in places like Ireland, Luxembourg, the Netherlands, Singapore, or various island nations. Other parts of the same company, operating in high-tax countries, then pay licensing fees or royalty payments to use that intellectual property. Those fees count as deductible expenses in high-tax countries and count as income in low-tax jurisdictions. On paper, profits move. The business itself, the actual operations, the factories, the employees, the customers, none of that physically changes. But the tax obligations shift dramatically. This practice is legal, widely used across industries, and extremely effective at minimizing global tax burdens. Transfer pricing works in a similar way and multiplies the effect. When different parts of the same company, different subsidiaries or divisions, trade with each other across international borders, prices must be set for goods, services, intellectual property, and internal transactions. Those prices are often subjective and difficult to value precisely. There's no external market setting the price when a company is essentially trading with itself. Regulators require that transfer prices reflect arm's length values, what independent parties would pay, but that standard leaves enormous room for interpretation. By adjusting transfer prices within allowed ranges, within legally defensible parameters, companies can shift profits to jurisdictions where taxes are lower and costs to jurisdictions where taxes are higher. Governments are aware of this. Regulations exist to limit abuse. International agreements attempt to coordinate enforcement, but the system is incredibly difficult to police effectively. Enforcement is slow, resource-intensive, and often constrained by political considerations. Countries compete with each other to attract corporate investment, jobs, and capital. Lower taxes, favorable treatment, and flexible rules become selling points in global competition for business. Tax incentives play an enormous role in this system, and they're often invisible to public debate. Governments frequently offer tax credits, exemptions, deductions, and special treatment to encourage certain behaviors and outcomes. Research and development, clean energy investment, infrastructure projects, job creation in specific regions, economic development in struggling areas, or strategic industries. Large companies are best positioned to take advantage of these incentives because they have the resources, the legal expertise, the accounting infrastructure, and the scale to navigate complex rules, hire specialists, and optimize compliance across multiple jurisdictions simultaneously. To the system, to policymakers, these companies aren't exploiting flaws or loopholes. They're responding rationally to incentives that were deliberately created to shape corporate behavior. There's also a timing element to corporate taxation that rarely gets discussed publicly but matters enormously. Companies can often defer taxes, push them into the future by reinvesting profits rather than distributing them. Money kept inside the company for expansion, acquisitions, research, or business development is treated differently than money paid out to shareholders as dividends. This structure encourages growth and reinvestment, which governments generally want. But it also delays tax collection, sometimes indefinitely. And when profits are eventually realized, when they're distributed or when assets are sold, they're often taxed at different rates depending on how they're categorized. Capital gains, dividends, and retained earnings all receive different treatment under most tax systems. The system is layered, deliberately complex, and companies are structured specifically to move through those layers as efficiently as possible, minimizing taxes at every stage. This is why headlines about companies paying zero tax are often technically accurate but deeply misleading about what's actually happening. Taxes may be deferred rather than eliminated. They may be paid in different jurisdictions than where revenue was generated. They may be offset by credits and losses accumulated over many years. They may reflect legitimate business expenses that reduce taxable profit even while the company remains highly valuable and operationally successful. But the deeper issue, the more fundamental question, isn't whether these practices are legal. They are. It's not whether companies are following the rules. They usually are. The real issue is why legality aligns so closely with corporate advantage. Why the rules themselves create these outcomes. Why the system is structured this way. Modern tax systems were built with competing, often contradictory goals in mind. Governments want revenue to fund public services, infrastructure, and social programs. But they also want investment, innovation, employment, and economic growth. They want companies to take risks, expand operations, and create jobs. To attract large companies, they offer flexibility. To encourage risk-taking, they allow losses to offset future profits. To stimulate development, they provide credits and incentives. Each individual decision makes sense in isolation, serves a specific policy goal, and reflects a reasonable trade-off. Together, they create a system where large, complex, multinational organizations are far better positioned to minimize taxes than individuals or small businesses could ever hope to be. This is not a conspiracy. It's not corruption, though corruption certainly exists. It's structural. It's how the system was designed to function. Smaller businesses and individuals lack the scale, the legal resources, the international reach, and the structural complexity to navigate tax systems strategically. They pay what they're told to pay. Large corporations, by contrast, are specifically designed to operate within these frameworks. Their size isn't just an advantage in the marketplace. It's an advantage in the legal and financial architecture of the modern economy. Understanding this changes how you see debates about corporate taxation. It stops being a simple matter of morality or enforcement. It becomes about incentives, design, trade-offs, and competing priorities. Changing outcomes would require changing the structure itself, fundamentally redesigning how corporate taxation works, not just blaming the players operating inside it or demanding better enforcement of existing rules. And that's why this topic keeps resurfacing in public debate without ever reaching resolution. The system produces exactly the results it was built to produce. The outcomes aren't bugs. They're features. If you want to understand how corporations, financial systems, and institutions actually function beneath public narratives, beneath the outrage in the headlines, this channel exists to break those structures down clearly, calmly, and completely. And if these explanations help you see the system more clearly, if they change how you understand power and money, subscribing gives you access to more analyses like this, the kind that explain how the world really works, without noise, without bias, without hype.